Hi, I'm Brad Docherty, founder, president, and CEO of Source Rock Royalties. Source Rock is a pure play oil and gas royalty company. We are exclusively focused on oil royalties in Western Canada. We've been around for 11 years, accumulating royalties in kind of a niche segment of the market. So the key to our business model is that we acquiring royalties only. We purchase a royalty interest and we have no ongoing capital costs and no future liabilities associated with those assets. Being oil focused, we're able to drive a very high netback or profit per barrel in our business. We run a lean operation and we're the beneficiary of top line revenue on our royalty interest. So Source Rock is the only publicly listed junior oil and gas royalty company in Canada. We have three much larger peers in the market, multi-billion market cap companies, and we're a 36 million market cap company that ultimately is again operating in our own niche, acquiring royalties that do not move the needle for our much larger peers. We have been public for coming up 2 years. We were private for 9 years prior to that. We have a nice clean capital structure with 45 million shares outstanding. We do have some warrants from our IPO. Ultimately, those expire March 1st, so that will clean up our capital structure a bit there. And then from the insider ownership standpoint, we have just under 10% insider ownership. Very strong alignment in terms of our insiders and myself as the founder owning 5% of the company. We have an average cost that is actually higher than our current trading price of the shares. So very strong alignment between insiders and our shareholder group. Ultimately, we have a lead shareholder in CN Rail Pension Fund who owns 21% of the company. They've been involved since 2014 and have participated in all of our financing since that time. Source Rock doesn't use debt in its business model. So, ultimately, we've always maintained a cash balance, accumulated royalty interest with our cash and our free cash flow. And currently we have about 1.4 million of working capital. We have a snapshot here of year-to-date results. It's been a record year for us in 2023. We had year-to-date average production of 205 BOE per day, greater than 90% oil. That gave us just under 5 million of revenue, 3.99 million of funds from operations. Funds from operations for our business is free cash flow. So strong free cash flow profile on the business. That high margin nature of our business drove a very strong year-to-date corporate netback, which is net profit per barrel after everything of 71.30. That's allowing us to pay a dividend very consistently on a low payout ratio of 54% year-to-date. And that was actually 47% for Q3, as Q3 was a record quarter with 228 BOE per day, again, greater than 90% oil ratio, and just over 2 million of revenue. So as I mentioned, we've been public since March of 2022. We've found ourselves in a interesting oil market since that time. And so, we went public when oil was kind of in the high 60s, low 70s. So we found ourselves, cashed up and ready to deploy capital on a pipeline of acquisitions that we saw. But ultimately, by the time we finished our IPO process, oil had taken off into the 90s and was on its way to, record prices in Canadian dollar terms. Hitting, $120, $125 US pricing, and then closer to 150 Canadian dollar pricing. So we decided at that time that we were going to, hunker down and not deploy our capital in that high price environment. We were ultimately benefiting from our existing assets, having all-time high revenue and all-time high production at that point in time because of strong oil prices. And we were also found ourselves getting paid very material amounts of interest to hold our cash and wait out the oil market for a better time to deploy. We then, late in 2022, we found ourselves in a better oil price environment, and we completed a series of 3 acquisitions, $3.5 million, $1.6 million, and $3.3 million transactions. I'll get into more details on those in a moment. And along that path of capital deployment, we basically positioned our dividend to kind of mirror our growth in that we increased the dividend 2 times in 2023, first with a 10% increase in April, and then a second 9% increase in October for a total of 20% increase on the year. As we still maintained a strong cash balance of 25% of our market cap in cash, late in 2023, we again found ourselves with our asset base hitting record production, record revenue, despite the pullback in oil. And then just recently, a couple of weeks ago, we completed a transformational $8 million transaction that added material existing production to our business and another growth wedge for the business going forward. So kind of looking at all of our activities since we went public, we've deployed $16.4 million since November of 2022 on 4 transactions. We increased our royalty production by 50%. We increased our royalty land by 100%. And importantly, we both increased our existing production profile in the business, our proved, developed, producing royalty barrels, and we also greatly expanded our upside potential in our royalty lands. So in terms of a bit more about our group, so after 11 years of running this business, I'm still the only full-time employee in the business. So we run a very lean operation. My focus as a corporate securities lawyer by background is to position our transactions, negotiate them, and structure them. And then obviously day to day now as a public company, I'm marketing the story to the investment community. We have a part-time CFO, Shireen Lowe, who has great industry experience in various roles, most recently holding several CFO roles, in particular upstream oil and gas. Her focus day to day is maintaining the financial record-keeping side of the business, producing financial statements, and she's been an amazing resource for the company. We then have this great group of independent directors. And so, really this group is put together by design in that, we leverage our group's expertise and relationships to help drive the business forward in a cost-efficient way. And so, as I mentioned, I'm the only full-time employee, but then we do have 2 geologists, an engineer, and 2 landmen on our board who really help drive the business from a vetting of transaction standpoint and from the standpoint of helping me identify acquisition opportunities for the company. We have a very long tenured group of directors. Scott, Gary, and John have all been involved since inception. And then we have 2014, 2015, and 2017 tenured directors. Recently, we've added one more director in June Marie earlier this year. So a very well-rounded skill set with our board, a lot of tenure to the group. We're very vested to building this company in the right way. And ultimately, again, we leverage our group's relationships to find unique acquisition opportunities for our business. So in terms of a bit more about our history, as I mentioned, we were private for 9 years prior to going public. We completed a series of equity financings and acquisitions as a private company from 2013 to 2021. Our financing range was 80 cents to $1.30. Again, we consistently acquired royalties over that time. We also quite consistently paid a dividend. We only had 2 quarters during that period as a private company from 2014 to 2021 where we did not pay a dividend, and that was during the depths of COVID. Going into 2022, again, we completed the IPO at a price of 90 cents. Really, we positioned that IPO to ramp up our acquisition strategy, as I mentioned. We then again started executing on that strategy late in 2022 and segued into 2023 with continuing with our acquisition efforts and growing the business. So we've got this long track record of consistently executing on royalty transactions. We've got a long track record of being cash flow positive, which is very important. We've actually never had a quarter in the history of the company that wasn't cash flow positive. And then importantly for our business model, we have a very lengthy track record of paying a healthy dividend. And so our business model is always going to be focused on a balanced growth and yield strategy. And so, as we're growing the business, expanding our royalty production and expanding our royalty lands, which we've been doing recently, as I mentioned, year-to-date record production of 205 BOEs per day, record Q3 2023 production for quarterly production of 228 BOEs per day. But at the same time, as we're growing this business, we're paying a consistent dividend to shareholders. So you can see here the gray wedge or the gray bar at the bottom. That is our dividend payout on an annual basis for each of those calendar years. In the backdrop here, we have the very choppy WTI price chart. And so you can see the consistency of our dividend despite the volatility in oil prices. We started paying a 1.5 cents per share quarterly dividend in Q1 of 2014. We paid that quarterly dividend for 25 consecutive quarters until COVID hit in Q2 of 2023. We paused the dividend for 2 quarters, reinstituted it in Q4 of 2020, then paid it for all of 2021, all of 2022, and again, a quarterly dividend for Q1 of 2023. In April of 2023, we then decided to transition to a monthly dividend. At that time, we increased the dividend by 10%. And then, as I mentioned, we increased the dividend again in October by 9%. So our current dividend is 0.006 cents per month or 7.2 cents per year. And that gives us about a 9% yield on our current share price. Adding up all those dividends that we've paid since 2014, we've now paid more than $15.6 million back to shareholders in dividends. And we're doing so again on a conservative payout ratio and not at the expense of growing the business because we are, again, growing the business materially along the way. So dividend sustainability is obviously very important for any company. Obviously, we've got this lengthy track record of paying the dividend now, but we like to point out that the dividend sustainability is very strong. ultimately in downside scenarios to current oil prices and to our current production levels. So what we're showing here is our Q3 results on an annualized basis. 228 BOE per day was our production in Q3. You can see our annual dividend of 7.2 cents per share. And so if we annualized our Q3 production and used $85 Canadian pricing, that would give us about $5.2 million of free cash flow in the business on an annual basis. And then we would have a dividend obligation of about $3.2 million. So you can see that would translate into approximately a 60% payout ratio. Now, looking to the downside, again, assuming flat production, this is prior to rolling in our recent acquisition that we did a couple of weeks ago, which added material barrels. You can see that flat production for the business would hit a 100% payout ratio on our dividend at approximately $55 Canadian oil prices, which would be anywhere, somewhere in the high 40s for a West Texas Intermediate US dollar price. So a lot of sustainability there on the dividend in downside scenarios. And again, obviously, we're continuing to try to grow the business through acquiring more royalties with our cash balance and through recycling free cash flow. So in terms of the actual strategic approach to our business, so again, we are royalty interest only. We do not operate any wells. We do not pay directly for the drilling of wells. We purchase our royalty interest for a fixed cost, and that is our entire exposure for that asset for the life of the asset. We have no ongoing development costs or optimization costs associated with the assets. And longer term, we have no abandonment, environmental, or reclamation costs. Once we own those royalties, it's very easy to own them day to day. So we, again, have minimal management costs on a day-to-day basis to run the business. Really, we just have standard personnel, public company costs on an annual basis to be listed in Canada. And obviously, again, our small staff is compensated through some cash and incentive securities. But really, we are very insulated from inflationary pressures, both macro and industry specific to the oil and gas industry. Importantly, I've mentioned a couple of times that we have a very strong netback in our business, or profit per barrel. And that is driven by two factors. One is that we are an oil-focused royalty company. Oil is obviously a strong price on a per barrel basis. The most important factor, though, is that we're benefiting from top-line revenue. So we have little or no exposure to deductions associated with producing from our royalty lands. So typically when our operators sell oil in the field at, let's pick a price, $90 Canadian, we would receive that $90 Canadian price. We are not exposed to the deductions associated with producing that barrel of oil that an operator would be. So again, very low cost structure, very insulated from inflation, and no future costs associated with developing our royalty lands. So in terms of our portfolio of royalties, so again, we've been at this for coming up 11 years. We completed numerous transactions over that time period. And that has gotten us to a point where we have quite a diverse portfolio of 155,000 gross acres of royalty lands. So ultimately, though, over the 11 years, we've completed different waves of transactions focusing on different areas of Alberta and Saskatchewan. So here on the left side of the map, this is Alberta. Over here is Saskatchewan. Our early years were focused on kind of the Central Alberta, Central Saskatchewan fairway, where we were really focused on building a base of royalty production. We were less focused on getting ourselves exposed to material growth and more focused on building a base of production for the business to grow itself from. So these assets that we accumulated between 2013 and 2021 are a little bit more of our vintage asset base, lower decline, less kind of growthy profiles associated with them, but again, provide a nice strong base of production for our royalty portfolio. In 2019, we really wanted to start pursuing some growthier opportunities for our business. So we took a pivot down to Southeast Saskatchewan and began completing numerous transactions down here. We initially acquired a portfolio of existing royalties. And then on the back of that, we completed a series of call it royalty partnership transactions where we worked with operators in this region to provide capital to them in exchange for a royalty in their assets, and they would then commit to drill the lands. So we have very consistently been seeing 2 wells per month getting drilled on our royalty lands in Southeast Saskatchewan for the last couple of years. And that has been an organic growth driver for our business. Importantly, as I mentioned, we just completed a very material transaction that is not only adding to our existing production in the business, but is also adding to the growth profile. So we acquired a royalty in this Figure Lake area, which is a Clearwater fairway, producing heavy oil. There's about 2,800 barrels per day of existing production from the asset, and we acquired a 1.5% royalty in these lands. There's 95 sections of land, or about 61,000 acres. Again, existing production, 2,800 barrels per day, which nets us 40 barrels per day of initial production. Now, importantly to our strategy is that not only are we getting the 40 barrels of initial production, but the operator of these lands committed to drill 59 horizontal wells on the lands over the next 2.5 years. So it's a very material capital commitment. It equates to about $110 million of drilling that will be undertaken over the next 2.5 years by the operator. So obviously that's positioning us with this new asset where we again get the backstop production of 40 barrels a day, but we expect consistent growth from the asset going forward. You can see that this strategy is consistent in our recent deals. So these are our last 4 transactions that we've completed in the last 13 months. And you can see each of these transactions has a capital commitment component to the deal. 3 of them are focused on drilling commitments, 15 wells, 12 wells, and 59 wells. And this one transaction was focused more on a capital commitment. And so again, the capital commitment is not specific to drilling wells, but it's a commitment to optimize the asset, ensure that the asset is maintained well, that it maintains the profile of that producing pool. And ultimately, this is a low decline water flood asset for us. There is actually 3 separate distinct light oil pools that we acquired a royalty in. And so the operator is committed there to, again, optimize the asset, ensure that it maintains its low decline profile. The other three transactions are more focused on growth. And so there you can see there's a bit of existing production with these acquisitions to provide a backstop on the transaction. And then there's these very material drilling commitments. So this 15 well commitment is about a $22 million capital commitment on our $3.5 million royalty transaction. 12 wells would be about $19 million on our $3.3 million commitment. And again, as I mentioned, this is a $110 million commitment on our $8 million transaction. So these are really reflective of the opportunities we're seeing. There will be instances where we can acquire a low decline producing asset at a low transaction metric. This was about a 2.5 times cash flow transaction metric for us. And then other transactions are going to have much higher growth potential associated with them, where we pay a little bit more as an entry price to get exposure to the lands at the initial production. But then the operator backfills that transaction with an extremely strong capital commitment and creates visible growth in the asset on a near-term basis. So ultimately, we have a very strong payor list in our diversified portfolio of royalty assets. 99% of our revenue is paid by this list of operators here. There's some very recognizable public companies on this list: Whitecap, Crescent Point, CNRL, Vermilion. Those are strong backstop payors for us. We then have various large private companies that contribute to our royalty production. Tyne Energy is owned by the Canada Pension Plan, so very well capitalized and well positioned group. And then there's ultimately a company called Tundra Oil and Gas, who's owned by the Richardson family out of Winnipeg, very, very well capitalized group. And then we have some smaller, I'll call it partners. And these partners, despite their relatively smaller size, are extremely well positioned businesses as well. So we've added, just like a couple of weeks ago, Rubellite Energy through this Clearwater transaction. They're a very well-positioned public company with deep capital markets experience and industry technical experience. And then 2 of our smaller private partners are Axium Oil and Gas and Innova Resources. Innova is the company in Southeast Saskatchewan that we've consistently been doing transactions with since 2019. They've been working in Southeast Saskatchewan for multiple decades, having a ton of success. Growing through the drill bit, importantly. So again, very, very strong payor list in our business. So in terms of the acquisition landscape that we see, and ultimately we went public with our business and listed on the TSX Venture Exchange so that we could execute on our acquisition strategy more efficiently. We found as a private company that it was somewhat inefficient to align our transactions with capital, and we didn't want to miss out on opportunities as again, we found ourselves in a very robust environment. In a sandbox of opportunities that we are positioning through our relationships and that we are not really competing against our peers for. Again, accumulating royalties that aren't going to move the needle for our larger peers and being really the only junior company implementing this strategy. So we can, as a business, acquire existing royalties, and over the life of the company, we have acquired a portion of our royalties through acquiring a royalty that already exists that somebody owns, and we purchase that royalty from the third party. In those situations, we are not establishing a direct working relationship with the operator of those lands. And so ultimately, we need to be very comfortable that the development of the lands is going to continue because we're not getting any kind of commitment from that operator to undertake ongoing operations on those lands. We are also able to acquire mineral rights on our own. And what that means is that we can go purchase minerals and then look for an operator to come in and develop those minerals, and we would keep a royalty interest. Ultimately, though, we've typically not undertaken too much of this strategy because we can execute on getting exposure to undeveloped lands through our royalty partnership structures. And why I call them royalty partnerships is because ultimately, as a provider of royalty capital, we are effectively purchasing a piece of the asset in the form of a royalty and becoming a partner in that asset with the operator. So royalty capital is very passive, it's very friendly. And given the dynamic that's unfolded in the oil and gas industry the last few years, royalty capital has really gotten to the top of the capital stack. The capital stack of these junior companies has largely been flipped upside down. And what I mean by that is that typically, in years past, early years of Source Rock, debt was the first access to capital point for companies. They would take on as much debt as they were, able to through their lenders, because ultimately they didn't get punished for it. They would take on high debt to cash flow ratios because ultimately it was a way to leverage returns for their shareholders. As multiple oil price crashes happened, though, we found that the lenders of traditional debt to the junior end of the industry have largely left as providers, and so they're no longer offering traditional debt to junior companies. At the same time, these junior companies have found that they don't want to be at the whim of their lender when times get tough, and so the balance sheets of these operators have become quite clean, and even if they want to get debt, it's largely become unavailable or the terms have become too onerous. At the same time, equity valuations have really been pushed down to low levels and stayed at these low levels for a long period of time. So for a company to undertake a material equity financing, it would be extremely dilutive, and potentially it's just not available anymore because the market in terms of investing in oil and gas has moved upstream on the E&P side of the world, where investors are looking to invest in the larger exploration and production companies as opposed to the juniors. So that's really brought royalty capital to the forefront, in that companies are looking to supplement their capital stack because debt and equity are less available, and royalty capital has really become more readily available through ourselves and through our larger peers to the industry, and it's become much more acceptable as a passive, friendly, positive way to fund either a new acquisition or fund the ramp up of development in a company's assets. So then in summary, as I've mentioned a couple of times, we are the only junior oil and gas royalty company undertaking this business model in Canada. And so we are operating in our own little sandbox of niche opportunities that we're pursuing through our relationships. We're going to be continuing to scale the business, not only on the top line, but given our low cost structure, we can drive material amounts of that top line growth to the bottom line. We are going to maintain an oil focus in our royalty acquisition strategy. And so we want to scale the business not only in terms of growing our existing production, but growing our exposure to undeveloped royalty lands. We are sitting here in the marketplace today providing the highest yield in the royalty peer group in Canada. So our yield being about 9% at an 80-cent share price is very attractive yield. And again, this is at the same time as growing the business. That yield is being provided on a payout ratio that's quite conservative. It's either in line with and in some instances lower than our larger peers. And we are providing this very strong netback as well. So our profit per barrel with our oil focused and strong capital efficiencies is, from our perspective, an industry leading netback. And we're positioned for very material growth. So as our Clearwater transaction that we completed shows, that was 25% growth for our business in one transaction. And, with our clean balance sheet, our remaining cash and our free cash flow in our business, we will be continuing to recycle that into new royalty acquisitions. And all of that, positive attributes of our business being said, we're trading at the lowest valuation in the peer group. And, we think that is a very attractive entry point, and something that we want to work towards improving because, again, we're running this business with a lot of track record and execution, very strong capital efficiencies, very strong yield with a low payout ratio, and we have a pipeline of growth opportunities in front of us.
Thank you for an excellent presentation, Brad. We will now move on to the Q&A session, which consists of 5 parts. The first part is about Source Rock's management and board, where we will discuss the history of the company, Brad's career, and how he has built the management and board. Thereafter we'll go through Source Rock's investment process, business model, royalty portfolio, and finally discuss higher level strategic questions. But first, we'll begin with the management and board. Could you tell us a little bit about yourself and your career?
Yeah, so by background, I was a corporate finance lawyer. I ultimately practiced for about 7 years working with various junior companies, some publicly listed, some private. Ultimately, exposed myself very early in my law practice to call it the boardroom, working with boards of directors and management teams quite closely, again, of very small companies in different industries. Took on some corporate secretary roles at these companies as a young lawyer, and really got to see kind of, how companies start, how companies endure challenges, how different things play out, both again in oil and gas and otherwise. And through that exposure, I learned a lot about, what not to do, and, the risks of doing different things in terms of getting a company started. And through that, again, I gained an entrepreneurial itch. Ultimately, kind of found myself, wanting to pursue starting a company on my own, and felt like I had the relationships to do so. And being in Calgary, Alberta, obviously it's oil and gas, the oil and gas community, and so I found myself looking to the oil and gas industry as a way to build a company, and I struggled with the whole dynamic of having field operations and having environmental liabilities and all that came with that. And so, I wanted to identify a way to build an oil and gas company that could be both scalable and sustainable through the ups and downs in the oil and gas industry. And the royalty market was just attractive to me because of the dynamic of owning a royalty interest that doesn't have exposure to those field dynamics. So, basically from my legal practice, I segued into, founding Source Rock, and it was, really, kind of a seamless transition to, having a small legal practice, and then ultimately starting the company at the same time by, doing friends and family financing and insiders, and doing our first acquisition. And then as, things gained traction, then I stepped aside from my legal practice and focused solely on Source Rock. And so again, really my legal background's been a great platform to be, utilizing my skill set through Source Rock, but ultimately it's allowing me to kind of, again, pursue entrepreneurialism, but not completely run away from my legal background, and use it to kind of, I guess, benefit the growth of Source Rock and the structure and the strategy and that. And yeah, so really, that's the history to me, and how I got into Source Rock is that, it very quickly segued from corporate legal practice to Source Rock, and that's, was 11 years ago, pretty much, today, and haven't looked back since.
Could you give us a summary of how Source Rock has evolved over time, and also why you ended up taking it public?
Yeah, so when we started Source Rock, the opportunity that I initially saw was to accumulate existing royalties, and ultimately, that was really going to be the focus of the business. We kind of had identified some ways to pursue them. There's no database of royalties to look up where they are. You have to kind of leverage relationships to find them. And I'd kind of pre-positioned some opportunities before launching the company that we were going to pursue. And so we completed a few initial acquisitions of existing royalties. And then ultimately, the market crashed for the first time. And so that was kind of mid 2014, the market crashed. Thankfully, we had done a funding event prior to that market crash. But then what we found was that quite quickly the acquisition environment changed. In that, when oil crashed, royalty owners didn't necessarily want to part with their royalties when the royalty revenue was down so low. And so then we quickly found ourselves looking at other opportunities and trying to identify, well, how do we continue to grow this business through a very different oil price environment and different industry conditions. And that's when we quickly realized that we could easily pivot to being a source of capital to the industry and create royalties that then attach to the assets of existing operators. And so ultimately, that has now been a back and forth process through the history of Source Rock. We're never entirely focused on one strategy, but ultimately the market circumstances and conditions at the time will dictate which of those strategies we're focused on more. And then really, going public was driven by, again, trying to access capital more efficiently. And so, as a private company, we would identify acquisition opportunities, and then we would look to align capital to complete those acquisitions. And sometimes we couldn't do that efficiently enough. And vice versa, the capital often wanted to know what acquisitions we were working on. And so, there was instances where we were missing out on acquisition opportunities because the access to capital process was more time consuming as a private company. And so we really felt like going public after 9 years of executing this business model was the right decision, because it would give us an initial tranche of capital to execute the strategy on, and then it would give us more efficient capital on an ongoing basis to continue the build out of the business.
You're an oil and gas entrepreneur, so how large is your equity stake in Source Rock, and how much of your net worth is allocated with Source Rock?
Yeah, so I own 5% of the company non-diluted, and so that's about 2.3 million shares. Importantly, I have no cheap founder shares in this business or anything. So I invested straight in with everybody else on day one at the same price. I participated in every financing that we have done in the history of the company, including the IPO. And then ultimately, I've bought stock periodically when permitted in the public markets, as recently as 2 weeks ago, on the back of our most recent transaction. So, netting all that out, it's greater than 75% of my net worth in Source Rock. And so I'm very aligned with shareholders. My average cost is actually higher than the current trading price in the business. And so, really that positions me as the founder and the president and CEO to run the business and build the business in the right way, because I'm not in any way motivated by anything than doing good transactions and creating a high profit margin business.
You're the CEO, you're the founder, so could you give us an overview of the management and board at Source Rock?
Yeah, so again, I am the only full-time employee of this business. And so, to emphasize, owning royalties once you own them is quite an easy process. And that's what allows us to have this lean platform or lean group. And so ultimately, again, my focus day to day is finding transactions, structuring them, negotiating them, and then ultimately marketing the company now that we're publicly listed. We then have a great CFO who's as engaged as we need her to be, depending on what's going on, and ultimately, but her main focus is the record keeping side. So we ultimately get royalty statements from each of our payors every month. That includes a well by well breakdown of every producing well on our lands, and so then all of that data needs to be accumulated and put into the system. And that's ultimately the focus of Shireen, our CFO, on a day-to-day basis. And then obviously she's the lead on preparing financial statements on a quarterly and annual basis. So again, that's the entire team day to day. We do have a land consultant that we utilize as needed. We do have outside geologists and engineers that we can engage on a transaction by transaction basis if we need them. We certainly have outside advisors in the industry that we work with, again, on transaction by transaction basis. And that includes our reserves evaluator. So Trimble Energy Group does our annual reserves, and then they'll also look at transactions for us when we ask them to. And then outside of those advisors, we have a board of directors who's a very, very seasoned group of individuals. And so, we ultimately have a group that has technical expertise and very in-depth niche relationships in the industry. And so again, our board has 2 geologists, an engineer, 2 oil and gas landmen, and then 2 accounting professionals on our board. And so our board will provide a technical backstop on our acquisition opportunities. Typically, we would only use our board exclusively. It's a very small transaction. If it's a larger transaction, we would utilize our outside technical advisors to help evaluate the assets, and then we would present that evaluation to our board to then vet the evaluation. And then, again, as I mentioned, importantly, our board is very engaged on the relationship side of the business. And so our acquisition strategy is to find our own acquisitions through our own relationships, negotiate directly with counterparties, and to not be bidding at marketed disposition processes and therefore competing more against our peers. And so we do really leverage our board's group to accomplish that.
Could you give us an overview of Source Rock's ownership? Retail, institutional split, and who are your largest shareholders?
Yeah, so our largest shareholder is CN Rail Pension Fund. They're based in Montreal, Quebec, and they're a 21% owner in our company. And so they have been involved since the mid 2014 financing that we did. And again, just like myself, they participated in every financing from that point forward in the history of the company, including providing a lead order on our IPO. So they've been a great shareholder for us to have. They're a very sophisticated royalty investor, having created one of our larger peers 2.5 decades ago. And so they're a great resource for us in terms of having a large institutional backstop shareholder. Outside of CN, we have another small kind of chunk of institutional ownership that we'd estimate to be around 4 to 5%. So call it 25% institutional ownership. We then have a 7.5% shareholder that is a U.S. retail individual, ultra high net worth retail individual. And then, as I mentioned, myself at 5% of the company. And then we have another close to 5% owned by the remainder of the board and management. So you put that kind of little group of shareholders together. We have CN at 21%, myself at 5%, the remainder of the board and management at close to 5%. We've got 31% ownership there. And then our US retail shareholder again is 7.5%. Outside of that, then we have a broad retail shareholder base. So we did do a full prospectus IPO when we listed, which involved 5 syndicate members, investment banks in Canada. And that was largely focused on distributing shares across their retail platforms across the country. Last comment on ownership, I think it's important to point out that since we went public, not a single share has been sold by an insider of the company. So I think that's something that we like to highlight. And as I mentioned, I've been purchasing shares recently. And there's been other directors and management involved in the company that have been purchasing shares in the open market as well. So strong support from insiders, which includes obviously CN Rail Pension Fund as our shareholder.
We'll now discuss Source Rock's investment process and ask how they screen for investment opportunities and how their due diligence and valuation process looks like, which is an integral part of any royalty company. Ultimately, you're a capital allocator, so let's speak about your investment process and also philosophy. So when you're evaluating assets, how often are you using consultants?
Yeah, so that will be driven by the transaction size. And so, ultimately, the larger the transaction, the more we are going to look to bring in outside advisors to give us different perspectives on the acquisition. If we're doing smaller kind of tuck-in acquisitions, those would typically just be looked at and vetted by our board. And because, again, we also ultimately have very strong technical expertise on our board. There's very, very, very seasoned geologists on our board and engineers. And so, we can certainly rely on their expertise for smaller transactions. Again, as mentioned, we have several outside technical advisors that we can work with. Those are individual consultants in some instances that we have longstanding working relationships with. But again, more importantly, we have kind of our actual, third-party technical groups that are working with our business actively. Again, that is Trimble Energy Group. And then one of our investment banking relationships in Calgary has geologists and engineers in-house. They've been involved working with Source Rock on both financing and evaluating transactions since 2014. So again, there's again kind of a back and forth on that depending on transaction size, but ultimately, material transactions are going to get various technical evaluations completed, which again is then going to all at the end of the day be vetted by our board.
How does the investment screening process look like?
Yeah, so again, my focus day to day is pursuing acquisition ideas, and so ultimately a lot of these ideas, are again me reaching out and cold calling groups that we would want to work with, and by say want to work with, I mean we want to create a royalty, attach it to their assets, and be involved with them and the growth of their company. Now we aren't going to our process initially will not be different than almost an investment process where, we're looking top down to say, who is the management team? What is the quality of the asset? How have they executed? Where is the asset? What existing production does it have to backstop the cash flow profile of the royalty on day one? And then what undeveloped land is there to attach ourselves to create a growth profile for the asset going forward? And so, typically, again, we are the ones kind of instigating that to reach out to these groups after doing our own kind of internal, assessment of them being a partner for us that we would like to pursue. But we ultimately obviously have, after 11 years, a lot of inbound as well. And so, if it's not something that we've already identified as someone we want to work with and an asset that we want to be exposed to, then we would typically, meet with whoever calls us and say, tell us about yourselves, tell us about your asset, tell us about your growth plans, tell us about how you're going to capitalize your growth plans. And then again, almost do an evaluation like we're investing in their business. Because effectively, from our perspective, we're buying a piece of an asset that they operate. And typically we want to be focused on assets that are core to the company that we're talking to. Wherein, again, we're not buying a royalty in their non-core assets. We're buying a royalty in their core assets that we can be comfortable they're going to develop. And then again, importantly, they need to be a group that's executed in the past. And so, we typically wouldn't work with a group that we don't already know quite well. And we obviously wouldn't work with a group that has no history of executing on developing oil and gas properties successfully. So really, top down, kind of investment evaluation approach. And again, that has multiple layers to it in terms of evaluating the people, the lands, the geology, the engineering, the capital, I guess, stack of the business, and how do we fit into that? And if we bring some capital to the table, does that does that just help them a little bit, or are they still not really able to execute on the growth they indicate? And how else may they fund that growth profile that they're communicating to us? And that again is kind of our process for evaluating the partnership side. So then in terms of evaluating existing royalties, that's a very different exercise in the sense that, we are not in those instances creating a working relationship with the operator. We are buying a royalty that somebody else owns that's operated by a different entity. And so then we would be really kind of purchasing that with a very risked base case. And so we would be saying, okay, what is the existing production? What potential drill locations are there on these lands that could get drilled in the future? And then we would be really risking the potential of those drill locations in our evaluation, because again, we're not getting any kind of commitment from the operator. The operator has no obligation to tell us whether they're going to drill wells. So we would be acquiring that royalty a little bit more blind to what's going to happen in the future. So it would be a much more stringent evaluation focused on geology, focused on the stability of the existing production, and less focused on what upside potential there is in the lands.
Once you have found a company or that has an asset, a core asset they want to develop, and they're interested in royalty capital from you, how do you go about the due diligence process and also valuation process when evaluating and also putting a value of how much you think the royalty that you're creating would be worth?
Yeah, so again, that's going to be driven by both geology and engineering, and so ultimately we're going to be looking at the value of existing production and existing proved developed producing reserves, and that will kind of create a base case value for the asset. Proved reserves are certainly important for that kind of base value, and important for us as a bit of a backstop on the transaction. And then we're going to be looking at the geology side and the amount of undeveloped land, the potential future locations. And then we're going to be heavily risking the potential upside drill locations. But ultimately, if there is material upside potential, we have to be putting some value on those upside locations. So assuming we're comfortable with the geology and the potential for future wells to get drilled on the lands, we're going to then be determining what amount of that potential upside are we comfortable paying for, and what amount of that potential upside do we hope to get for free? And by free being, we're not putting a value on it today, but it's got a high likelihood of turning into future value. And so again, that's going to be driven by geology, engineering, and really, cost of capital at the time. And so, ultimately, in times where the oil and gas industry in general is getting a higher valuation, well, that will allow us to ascribe value to more potential upside that we feel is there. In times where the oil and gas industry has a weaker valuation, well, then that doesn't allow us to put a ton of value on undeveloped, unknown future potential. So again, every transaction looks a bit different, but generally we're creating, approved producing reserve value from a reserve evaluation standpoint. And then we're assessing the upside potential and putting a value on a portion of that upside potential.
What's Source Rock's view on diversification?
Yeah, so we've again been oil focused for the entirety of the company, and so from a commodity diversification standpoint, we've particularly avoided that. We've been oil focused purposely, and that's largely driven by the fact that natural gas typically has less margin there to put a royalty on. But more importantly for us, it's that our relationships in the industry are in the oilier parts of the basin. So again, we've been very oil focused. Now in our portfolio, though, we've kind of exposed ourselves to two different regions. We've got West Central Saskatchewan and Central Alberta. That has one sales point at Hardisty. And then back in 2019, we pivoted down to Southeast Saskatchewan to create a sales point diversification. And so all of the oil down in Southeast Saskatchewan goes to Cromer, Manitoba, which is a completely different sales hub than Hardisty. And so through those kind of efforts, we created oil price diversification through getting exposure to two separate hubs. Again, as mentioned, we've been very oil focused, and that has had a light oil focus. We just recently, again, completed the Clearwater transaction 2 weeks ago. That was our first step into doing heavy oil. And so that was a pure heavy oil acquisition, which again, we purposely did at this time because we felt that it was the right point in time to get some more diversification in our oil. And so we are now getting exposure to some Western Canadian select oil pricing. That is purposeful today because of the future onset of the TMX pipeline that we anticipate in the next year or two. We anticipate that pipeline coming on will materially reduce the differential on Western Canadian select pricing. And we felt that now is the time to get our first exposure to heavy oil barrels to hopefully benefit from that differential reducing over time. The differential is currently around $20. And obviously there's different estimates out there, but some of them are thinking that differentials could stabilize and reduce down to around $10. So obviously that would be a direct benefit to us purchasing WCS exposure in a $20 differential environment.
The third pillar of Source Rock's investment case is its business model, where we will discuss how Source Rock gets paid and what is deducted from the revenue. First of all, do you get paid in cash or in kind, i.e. you get the barrels?
Yeah, so all of our royalty agreements are set up to allow us to take barrels in kind. We have never exercised that right, though. So it is a standard right as a royalty owner to take barrels in kind. But ultimately, to take barrels in kind, that would require some infrastructure, so to speak, and that we would have to arrange our own marketing contracts. We would have to, manage the sale of oil in the field. And so for us, given our strong payor list and ultimately the companies that we work with, we kind of benefit from their infrastructure in the field. We benefit from their relationships on the marketing side. We benefit from their economies of scale in that, they're selling larger volumes of oil and we're getting the price associated with those larger volumes of oil. So for us, we've always taken all of our payments in cash. We always maintain the right to take in kind. But for us, there's just not enough scale to any one area for us to convince us that it makes sense to take our barrels in kind, because again, we are benefiting from our operators in those areas that have larger volumes to sell. But again, I think importantly, the right to take barrels in kind is always there. And so if we ever feel like an operator isn't getting appropriate pricing for that area, then we have the ability to pivot to taking barrels in kind.
But in oil and gas, what is deducted from your royalty revenue? Differentials? What expenses are deducted from the revenue that you receive?
So generally speaking, we benefit from top line revenue, and that is, we get the sales price in the field. There are some older royalties that are part of our portfolio that they have some allowable deductions. That's typically limited to what's allowable under a crown royalty. But again, that's a very small portion of our portfolio. So, ultimately, the vast majority of our portfolio is a strict no deductions structure, where ultimately the sales price in the field is the price that we receive as the owner of the royalty.
Say that you have a 2% gross overriding royalty on a property. Do you get 2% after the crown royalties have been deducted, or you get just 2% of the actual gross revenue?
Yeah, so the percentage is based on production, not on revenue, right? So it's 2% of the gross production from the property. And so, if the crown royalty is 5%, then the crown gets 5% of gross production, we get 2% of gross production. So, our 2% is not net of the crown's portion. It is a gross.
The fourth pillar of Source Rock's investment case is the company's royalty portfolio, where we will go through production figures, royalty deals, especially the most recent deal in the Clearwater formation. We'll also talk about the importance of drilling commitments. Which are your major royalties and how each of them contribute to your production?
Yeah, so again, our portfolio is quite diverse at this stage of doing 11 years of transactions. And so, I think the focus of us has always been to have a balance between Saskatchewan and Alberta. Currently on the back of our Clearwater transaction, we would estimate that about 60% of our production comes from Alberta, 40% of our production comes from Saskatchewan. To break that down a little bit more, about 37% comes from Southeast Saskatchewan, which has been a very a focus area for us. And then on the back of the Clearwater transaction, we will have about 24% coming from what we call Central Alberta, and then we will have 31% coming from East Central Alberta. So again, quite kind of mix and balance in there. The Clearwater transaction is obviously a material deal that we just did, which is adding 40 barrels a day of initial production with a strong growth profile to it. As I mentioned, Southeast Saskatchewan at 37% of our production is a very material area, but that is very diverse within that area. So, we have, 35,000 acres of royalty lands in Southeast Saskatchewan. and there is a large number of wells contributing to that 37%. It's not concentrated on one property. And so again, it's tough to say in those areas, well, which property is leading, because Southeast Saskatchewan is very diverse in terms of properties. Again, the Clearwater transaction at 40 barrels a day is now about 25% of our production. And then we have a property in East Central Alberta that is currently about 30% of our production. And so ultimately, again, diversity amongst those, but ultimately there is some concentration from an area standpoint. And obviously, again, that's kind of evolving over time as we do more transactions. Some of our historical areas that we've done deals in that were historically larger contributors are now kind of getting diluted down through our acquisition strategy and becoming smaller percentages of our portfolio.
You just closed a large royalty deal, your largest royalty deal as a public company. In the Clearwater Formation at Figure Lake, Rubellite Energy is the operator. Could you summarize the terms of the transaction as well as the rationale behind it?
Yeah, so we acquired for $8 million gross purchase price, subject to some deductions. Deductions being adjustments to the purchase price, from a closing perspective. So it'll be about a $7.8 million net purchase price for us. That's giving us just over 40 barrels a day of initial production. We acquired a 1.5% royalty in 95 sections of land, which is about 61,000 acres. Now, Rubellite has been aggressively drilling these lands, so they have production coming from these lands of just over 2,800 barrels per day. And this is a very focused asset for them. So they have been focused on it for the last 12 to 18 months, and they intend to be focused on it going forward. So the rationale for us is that, first off, Rubellite's a very well-positioned group, strong company, strong operating history, strong capital markets relationships as a management team. Figure Lake is one of their focal assets in terms of where they're concentrated in terms of their development capital as a business. And importantly, they've established a material enough existing production profile that our royalty in that initial production profile is a very strong backstop on the transaction. Having exposure to 2,800 barrels a day as a day one contributor to our business is a great position to be in as a purchaser. But then most importantly to the transaction is that, we're obviously not always just looking to buy an existing proved producing wedge on the business. We want to be exposed to growth. And so given Rubellite's intentions to be very focused on this asset, they were willing to commit to a substantial amount of development going forward. And so ultimately we took a 1.5% royalty in current production and the 95 sections of undeveloped land. And Rubellite committed to drill 59 horizontal wells on these lands over the next 2.5 years. And again, for context, that's about $110 million worth of drilling. So our structure is set up where we benefit from not only the existing production, but any growth in production from that 59 well drill program. We get 1.5% of that gross production. And then ultimately, when we eventually get paid back on the transaction, our royalty will reduce to 1% in the asset for the productive life of the lands. So again, very strong existing production wedge, very, very strong capital commitment from Rubellite to continue to grow and develop the production on the lands. And so a transaction that we're very excited in that provides us with great optionality going forward in terms of having exposure to ongoing growth.
Post the Clearwater deal, how much production will you, as a ballpark, have? And what will the production split look like in terms of heavy oil, light oil, NGLs, nat gas?
Yeah, so we don't have a formal forecast out in the market in terms of forward-looking production, but just to kind of talk through the numbers we know today, Q3 production was 228 BOE per day. That was more than 90% oil. That again, we produced kind of 92, 93% oil and NGLs prior to the Clearwater deal, and that is about 1% NGLs, about 1% heavy oil, and then 91% light oil. So obviously the Clearwater transaction is adding initial production of just over 40 barrels a day. We're kind of more thinking a normalized production level on the back of a strong Q3, somewhere in the 240 barrel a day range. That is going to have a ratio of oil that's even greater than our most recent results were. So we're anticipating kind of 95% oil weighting. That would be approximately 25% heavy oil now on the back of this transaction. And then effectively the rest of that is light oil.
Could you add some color to Rubellite's drilling plans for the gross overriding royalty lands at Figure Lake?
Yeah, so again, they've committed to drill 59 wells over 2.5 years. And so ultimately we anticipate that to be, fairly front end focused, but ultimately balanced throughout that 2.5 year period. And so ultimately, that is the kind of context of the plans, and that, we anticipate them to consistently be drilling the lands. Ultimately the exact timing of wells, pluses and minuses here and there, just in terms of field dynamics, reacting to results in certain wells. But ultimately we anticipate them to very methodically expand the existing pool. And so that is the benefit of having 2,800 barrels a day of production, is that they don't have to go do, wildcat exploration. They can just methodically step out from their existing pool, drill spacing unit by drill spacing unit. Ultimately, some directions are likely going to be stronger than others, and they will learn as they go, and then they will pivot their drilling strategy based on where they're having the strongest results. And so again, we expect that drill plan commitment to roll out over the 2.5 year period in a very consistent fashion. And we trust, given how important this asset is to their business, we trust that they're going to develop this asset in a methodical way and do so in the best interest of not only themselves, but of Source Rock as their new royalty partner.
So earlier this year, you closed a royalty deal in Central Alberta, the water flooding deal, if I may call it that. And it had a capital commitment instead of a drilling commitment. Could you just add some color to that deal?
Yeah, so again, ultimately the drill commitment transactions are specific to a number of wells. And in those instances, there's actually a penalty for the wells not drilled. So it's a per well penalty in each instance. So if they don't drill that number of wells on the timeline set out, then they have to pay us back some of the purchase price. As you mentioned, the Alberta water flood property transaction was a bit different. These are three distinct pools of oil that have been producing for a long time. They're already under water flood, and neither us or the operators expect upside drilling to happen on the lands. But we completed that transaction at a very low cash flow metric, about 2.5 times cash flow at the time. But we ultimately wanted the operator to still commit to keeping the asset as a low decline water flood asset in a prudent way. And so, they committed to put capital into the asset to optimize the water flood, ensure that the water flood is being implemented appropriately, to ultimately maybe complete some recompletions of wells that have been shut in, again, to try to kind of prop up production and keep it strong. But ultimately, they don't have to drill wells on these lands. Again, it's more of a capital commitment to optimize and enhance production on the lands, to again maintain that low decline profile of the asset.
What are the advantages of drilling commitment instead of capital commitment?
Yeah, so again, I think it's just a different approach to getting exposure to assets that is all a part of building a portfolio. And so, for us, the Alberta light oil water flood project, again, was a very low cash flow metric transaction. We paid about 2.5 times. We've owned that asset for 11 months now, and we've been paid back approximately 40% in that 11 months. But again, we don't expect a bunch of growth from that asset. So the drill commitment structures that we do, though, in those instances, there's typically less production relative to purchase price, in that, we're getting exposure to lands that are earlier stage in their life, where, we're getting, again, a little bit of existing production to act as a backstop piece of value on the transaction. But really, we're needing to pay for some upside. And so typically when we, again, evaluate these transactions, we're always gauging, well, what's the right amount of upside to pay for? And so, if we think there's 60 drill locations on some land, well, we're going to try to only pay for 20 of those drill locations. And we're going to want to get as close to a commitment to drill those 20 wells as possible, because we're providing front end value for those undeveloped locations. And so the drill commitment not only helps backfill the valuation on these earlier stage projects that have a lot of undeveloped land associated with them, but they also create visibility and certainty to a growth wedge in the new asset that we're bringing in. And so ultimately, again, the transactions that we've done in Southeast Saskatchewan and the Clearwater recently, those had very substantial drill commitments relative to purchase price. We're getting a drill commitment that's multiples of our purchase price to really ramp up growth on those assets. And again, the benefit for us is not only does it create growth near term, but it ensures that the royalty lands are getting de-risked to kind of position ongoing development on the lands. And so, there's really no stale period for us when we get those drill commitments. We have some existing production. We have a drill commitment over a short period of time. It creates near-term growth. And then when those wells are successfully drilled, it positions follow-on locations. And as I've mentioned, we're typically focused on doing these transactions with operators that are focused on the areas in which we're doing the royalty transactions. And so then we're comfortable on the back of those drill commitments successfully happening, that then the follow-on locations are going to get drilled consistently and prudently because the operators, again, are focused on these lands as a core part of their business.
We have now arrived at the final pillar of Source Rock's investment case, where we will discuss higher-level strategic questions with Brad, such as outlook for royalty deals, dividend track record, how he sees the cost structure at Source Rock evolving, and much more. You mentioned in the presentation that you have some competitors. It used to be primarily debt, but so could you summarize, in the current market conditions, who are your main competitors? Are we talking other royalty companies, lenders, equity, etc.?
Yeah, so I mean, there's three larger public companies that implement similar business models, and so there's three other pure play royalty companies. Again, they're kind of 2 to 6 billion market cap companies. As I've mentioned throughout, the conversation here, that we're not really focused on pursuing acquisitions that they are going to be focused on day to day, because we're obviously a much smaller version of the business model. So we, although they're technically competitors in the sense that they're implementing the same business model and may at times pursue similar opportunities to us, generally speaking, we don't really run into them in our efforts to build the business. But at a base level, they're competitors for sure. Really though, day to day, what we're finding in our pursuit of these smaller transactions that don't move the needle for our larger competitors is that, there is kind of varying groups out there that just like to own passive income. And they're starting to recognize the value of owning royalties. And so, every once in a while, we run into, family offices that are out there pursuing royalty acquisitions. And, ultimately, I guess that would be a competitor group. But, we really kind of believe that it's a relationship-driven acquisition exercise. And so, we don't necessarily think that the groups that are out there kind of periodically trying to acquire royalties because they're nice to own, that they'll, kind of gain a lot of traction. It's a business model that requires the boots on the ground consistently, being there kind of ready to transact, and importantly, being, a partner to the industry that, is viewed as someone that can be there on a consistent basis, not on a one-off transaction, but on a go-forward basis. So, again, ultimately from an actual acquisition of royalties standpoint, we have a couple of different competitor groups there, but neither of them are groups that we run into day to day on our own. Ultimately, debt and equity, right now, I mean, it's a challenging environment for junior oil and gas companies to take on debt or to raise equity. And so, today, I would say that royalty capital is much more attractive, generally speaking, to the junior segment of the industry than either of those forms of capital. But ultimately, over time, that's going to evolve. And so ultimately, as the markets go up and down, debt becomes available, then becomes less available. Equity valuations go up, equity valuations come down. And we're able to kind of always just pivot and fit ourselves in between and ultimately make sure that, we're not trying to do transactions on unreasonable terms. Because ultimately, if our terms are unreasonable relative to debt or equity, then we're not going to get those transactions done. But, as I've mentioned again, the willingness of the industry to do royalty transactions has really ramped up because of the fact it doesn't come with the dilution of equity, and it doesn't come with the handcuffs or the really kind of stringent terms that debt would provide. So, again, I don't think it's direct competition day to day. It's more just, it's a relative evaluation process. And so, debt or equity being available isn't going to eliminate our acquisition opportunities. It's just going to always, change the actual cost to us, because we're going to have to constantly be looking to fit ourselves, kind of in the capital stack relative to debt and equity. But right now, we find that the acquisition marketplace for us right now is as robust as ever. Again, it's being driven by equity valuations being very weak. General inflows into exploration and production companies, especially on the junior side in Canada, being low. Debt costs being high, and or debt not being available because of the stringent terms, and just the ups and downs of the industry over the year has seen a lot of the traditional debt providers leave leave the industry.
With the current oil prices, most Canadian E&Ps, they generate positive free funds flow. So what companies are interested in selling royalties to you or letting you create royalties for them? And also, what are the companies using the cash for?
Yeah, so I totally agree, right? I mean, the industry is better positioned than ever, which is somewhat counterintuitive to this being the best acquisition environment that we've ever found ourselves in. And so ultimately, I think again, it ties into what I just said in that a lot of these companies don't have access to debt or equity on terms that are reasonable, and so they are living within their cash flow. And so although they have strong cash flow profiles on their business, that's not enough to execute on all of their growth ambitions. And those growth ambitions can be multi-layered. That can be acquiring new producing assets. That can be acquiring new undeveloped land. That can be ramping up development drilling. That can be testing new plays, exploration drilling on lands that they already have. And so for companies to do all of that within their cash flow, and in this market, most companies are getting pushed to pay a dividend. They're getting pushed to pay down debt. They're getting pushed to do share buybacks. And so cash flow can't check all of those boxes. And so, what we're finding ourselves positioned well with is where you've got a good company with strong cash flow profile and a pipeline of opportunities of their own, both on their existing assets and in terms of consolidating other assets in their focus areas. And so really, we're working with companies that want to either ramp up development of their existing assets or they want to execute on an acquisition. And so then we're being we're getting traction on being part of the capital utilized to execute on those two components of their business. And so again, cash flow only goes so far, and there's a lot of things that companies are being expected to do in the marketplace. And so really we're just supplementing part of that, and we're kind of helping them check as many of those boxes as they can in terms of building their business in all of the ways they want to, and providing the consistent return of capital strategy to their shareholders as well.
How do you fund the upfront considerations for the royalty deals?
Yeah, so we've always completed all of our acquisitions with cash on hand, which has always come from equity financings, or then obviously recycling free cash flow. So we've never utilized debt in the business. We've always either raised equity concurrently with doing a transaction, or we've pre-raised equity and then undertaken an acquisition strategy with the equity raise. And again, ultimately, our business has a very long track record of being free cash flow positive. So ultimately, if we have periods of time where we don't complete an equity financing, then obviously we're always going to have free cash flow to recycle into new acquisitions as well. And again, like for instance, we didn't do an equity financing from 2019 to 2022, but we were able to keep doing transactions through recycling our free cash flow.
I know that debt isn't part of your business model, but still, especially when the cost of debt was low, which it was for 2 years ago, why are you completely avoiding debt?
Yeah, because we don't control the development of the assets, and so ultimately we don't control the pace of development. We don't control the actual field operations and success of development, and we don't control the price of oil. And so, ultimately for us, we've just always felt that maintaining a pristine balance sheet is the right prudent strategy for a royalty company to implement, because we always anticipate that there's going to be ups and downs in the industry, and we don't ever want to be at the whim of a lender, deciding that they don't want to be our lender anymore because the industry conditions have gotten challenging, and they expect us to pay them back faster or on more stringent terms. And so our equity shareholders have always been there for us, and we always want to make sure that they're first in line, and ultimately don't ever want to risk the equity value of the business because we take on some leverage to try to ramp up returns. And ultimately, stepping back from that philosophy, debt relating to royalties is a bit more challenging than debt relating to an exploration and production company. And so, we don't feel like we would get very much access to debt even if we did pursue it. And so, to kind of muddy our capital stack with a little bit of debt that probably wouldn't really ramp up growth that much, we really feel like there might be a greater harm to our equity value and our equity holders than the benefit that would come from utilizing debt to grow the business a bit more.
You just closed a large deal, so how do you see next year lining up in terms of royalty deals? if you could give us a rough outlook.
Yeah, no, absolutely. And so, again, as I mentioned, we have some cash left over post our Clearwater transaction. We're about 1.4 million of working capital. That'll be increasing about a quarter million per month as we go here. So we will build up a cash balance a little bit quite quickly. But ultimately, the pipeline of acquisitions is robust, and so we're going to be looking at how do we fund the next phase of growth of this business. I think, as I mentioned earlier, we believe that we're materially undervalued, relative to our peers, more punitively than we should be for being a small company, because we're obviously providing this strong, consistent yield and running the business with very strong capital efficiencies. So our goal is to really expose the story on the back of the 4 transactions we've done in the last 13 months. Hopefully we can accomplish getting a bit of a valuation re-rate in the market and position whatever the next round of funding looks like at a better valuation for the business that allows us to do high quality transactions in an accretive fashion. And so, as I mentioned earlier, we went public to have access to capital more efficiently. And so, our goal will be to position that efficient access to capital at a reasonable valuation to undertake our acquisition ambitions, which again, the pipeline is robust. And to kind of comment on something I said earlier, we went public at 90 cents per share. Our share count has not increased since that time, but we've increased our royalty production by 50%. We've increased our royalty lands by 100%, but our share price is down 10 cents. And we've also increased our dividend twice. And so, we ultimately feel like, there's definitely some room to, regain market traction here and establish a more appropriate valuation on the back of the 4 acquisitions that we've done.
What is the expiry date on the outstanding warrants?
Yeah, so those warrants were issued in March of 2022 when we did our IPO transaction, and they will expire on March 1st of 2020.
We talk about capital deployment, so a large part of Source Rock's success has been your ability to generate free funds flow and then pay it out as dividends. So could you tell us about your dividend track record?
Yeah, absolutely. So we began paying a dividend in Q1 of 2014, and we started off with paying a 1.5 cent per share quarterly dividend. We paid that quarterly dividend for 25 consecutive quarters from Q1 2014 until Q1 of 2020. When COVID hit in 2020, we paused the dividend for 2 quarters, Q2, Q3, and then we reinstituted a dividend in Q4 of 2020. We then paid that 1.5 cents per share for all of 2021, all of 2022, and for Q1 of 2023. And then in April of 2023, we transitioned to a monthly dividend, and at that time, we increased the dividend by 10%. We then paid a monthly dividend for 6 months at that level, and then increased that monthly dividend by another 9% in October. And so that's got us here today to our monthly dividend of 0.006 cents per month, or 7.2 cents per year. And adding all that up, we've paid more than 15.6 million back in dividends over that time period. With our most recent payment last week, that's actually up to 15.85 million now, and so it's increasing monthly. So very substantial dividend repayment in the business. And our strategy has always been to have an annualized payout ratio of 50 to 70% of free cash flow. We've obviously been on the lower end of that recently, with Q3 being 47%. And year-to-date 2023 being 54%. So, providing a strong, consistent yield will continue to be, a focus of the business, but not at the expense of growth. So, again, it's about a balanced growth and yield business model. We always want to be expanding our existing royalty production, expanding our royalty lands, and providing that strong yield by flowing 50 to 70% of our free cash flow back to shareholders.
What is your view on dividends contra share buybacks?
Yeah, so buybacks are likely not something that we'll implement in terms of returning capital, primarily because we have a very tight shareholder base as it is, and so as we're looking to grow as a public company, we don't want to be taking away liquidity from the market. We want our stock to be as liquid as possible, and us not be the purchaser of those shares. Because ultimately, we're trying to consistently find new shareholders. And as a fairly tight float, there's not always readily available stock for sale. And so, we definitely want to make whatever stock there is for sale available to potential new shareholders. At the same time, we don't want to be shrinking our market cap through acquiring stock and then returning it to the treasury. So, we want to be growing our market cap, because ultimately as a public company, as your market cap grows, it allows you to kind of get in front of a larger audience. And so, we don't want to be shrinking that market cap. But I think most importantly for us, we have, a certain amount of free cash flow. We want to allocate a certain portion of that to dividends. And then we want to be using the rest of that to continue to scale and diversify the asset base, because this is a balanced growth and yield business model. So, if we use 50 to 70% of our free cash flow to pay dividends, and then we use another portion of our free cash flow to buy back stock, well, that doesn't leave a lot of free cash flow to continue to grow the business. And then lastly, we really feel like returning capital to shareholders in the form of dividends gives our shareholders the ability to decide what they want to do with that income that they're getting. So, we don't feel like we should be telling them they have to proportionally own more of Source Rock. Owning our shares, we want to reward them through a strong dividend, but we again want them to be able to use their discretion to determine what they want to do with that income that they receive from our business.
So as I said, I mean, you're the only full-time employee, so a very tight cost structure at Source Rock. So, but could you still outline the cost structure and how you see it evolving in the coming years as you grow?
Yeah, so one of the business strategies in our acquisition efforts is to complete simple transactions. And by simple, I mean that, we're not taking on a wide, diverse, for lack of a better term, messy royalty portfolio that we then have to spend a bunch of time managing day to day. And so, our transaction strategy has been, again, to focus on simple transactions where we can own them without having to, build a more expensive cost structure behind it corporately. So, as we're completing these transactions, we really have no immediate increase to our cost structure. And so, we acquired the Clearwater royalty. We had 25% production growth on the back of that royalty transaction, and we have zero increases to our corporate cost structure. And so, that is our goal going forward, is that we can maintain that very tight, clean cost structure, scale the business materially from here without having to backfill the cost structure to manage the assets. Now, over time, there's going to be a point where we get to a size and a scale that you need to layer in some administrative, costs to manage the business. But we, after 11 years, we really feel strongly that, building out the management team of the business, which is obviously which is what would grind, cash flow in a material way for shareholders, is not something that we need to do. Ultimately, owning royalties is a simple thing once you own them, unless you acquire a portfolio that needs a lot of administrative management. So, again, our goal is to grow in a simple way, to be driving almost all of the revenue growth to the bottom line, and really maximize free cash flow in the business.
Where do you envision Source Rock Royalties in 5 years?
Yeah, so ultimately, like I've said, we feel like the acquisition landscape right now is the best it's been in the 11-year history of the company. And so, we would love to have oil hang out in a, call it $70 to $80, $70 to $85 WTI price environment, so that we can execute on a material amount of growth. Now, that is going to require us, getting a reasonable valuation in our business so that we can accretively complete high quality transactions. But, there is no reason from our perspective that if we can access capital efficiently and at a reasonable valuation that we can't, double or triple the size of this company. Again, that's going to be a process of, tapping the capital markets, completing acquisitions, and building the business in a lockstep way. But, ultimately, we will obviously, I'm sure, find ourselves at times over the next 5 years in very high oil price environments. And during those very high oil price environments, we would likely be less acquisitive. We would likely sit back and benefit from the strong oil prices through our existing portfolio. And we're going to find ourselves in lower oil price environments where, that's going to hinder revenue. It's going to, hinder the drilling activity on our lands. And it's probably going to make us less hesitant to complete material transactions, but we're going to opportunistically look to still deploy capital. So, if we find ourselves in a middle ground oil price environment for the next 5 years, and we have the access to capital that we hope to have, then we would expect material growth for the business over the next 5 years. Because we have this pipeline of deal flow that we've positioned through our relationships for a long period of time now, and industry conditions are such that that the opportunity set is robust and readily available for us. Ultimately, the question becomes, how much can you execute on through our own capital stack?